Hello everyone and welcome back to Monthly Money Plan. My name is Jonathan and today we're going to be discussing top 9 financial goals to achieve before you are 30. Now with that being said, if you aren't subscribed yet and you enjoy this content, please click the subscribe button. I would love to have you on board. We're trying to hit the first 10,000 subscribers in the first 3 months. But with that being said, let's jump into it. Number 1 is having a 6 to 9 month emergency fund. Now this is super important, especially as you get into your 30s, because life does happen. Sometimes it's health issues, other times it's maybe a job loss or moving states for a different partner, starting a family. Whatever the occurrence might be, it is important that you are protecting yourself against the potential risk of having 6 to 9 months of needing a cushion. This is not meant to be forever and replace something like an insurance policy, but it's meant to be something just to give you that little cushion in case you need it. Especially as you get older, not relying on your family members or your friends if something dire were to happen. Number 2 is listing all your debts smallest to largest and completely paying them off. This is called the debt snowball. Now I completely understand that sometimes there is a lot of student loans to work through. And if that is the case, you might have to dig even deeper to get out of debt. Let's use the example they have $20,000 in debt. The first debt is $5,000 of credit card debt, and the remaining $15,000 is a student loan payment. With that being said, and the remaining $15,000 is a student loan. With the debt snowball, you would start off with the smallest debt, which would be the credit card for $5,000, and you would attack the balance. Pay it off as quickly as possible, put every single dollar you have towards that. The average credit card interest rate in America is 20 to 29%, which is absolutely absurd. But when you pay that off, it'll free up a lot of space in your budget to do that for the student loan. All that money you're putting towards the credit card, we now pivot that towards the student loan and absolutely attack the balance. From there, once you've paid off your debt, and now you are working towards actually figuring out more of your habits in the financial world, it leads to number 3, which is figuring out your automated monthly money plan. Now I like to call it a monthly money plan instead of a budget. It's basically the same thing, but you automate all your expenses each month so that it actually becomes a fun process. Humans are extremely habit driven, so we stick to similar habits throughout most of our life. With that being said, with the monthly money plan, what you're gonna wanna do first is in this step, you're gonna print out 3 to 6 months worth of balance sheets. So that's bank statements for your credit cards, debit cards, looking at PayPals, if you're using any other accounts, print them all off. And what you're gonna do is figure out where your money is most going. This is crazy when you actually look at it, because you could assume, hey, I go for dinner 12 times a month. It's probably not that much. And then you look at your statements, add them all up, and you realize you're spending $1,600 a month on restaurants with an income of $60,000 a year. That is a ton of money. You could pay off your mortgage early and some. So once you look at all your bank statements, you want to automate what is going wrong. And that's the first step. You're going to look at everything and say, do I spend most on electronics, or is it Amazon, or is it clothes, food, shopping in general? And you're going to want to set a cap to that. This is going to actually cap a later step that we're going to walk through, but it's super important with figuring out your habit and your weaknesses. Number 4 is building your credit. Now that you're debt-free, you're actually understanding where your money's going, now looking at building your credit for when you get real estate, buy a car, and actually advancing and building wealth. Now, a good place to be as a credit score is 750 and above. And a rule of thumb is you don't want to be over a 30% in your credit utilization rate. This is going to help the bank realize that you aren't maxing out your credit cards and using every penny on debt as possible, but you're actually using that responsibly and building up your credit long term. The soonest you can start building up your credit, the better. We're gonna do an example on 2 people that we have here. Number 1 is, we'll call him John. John has a decent credit score of 750, and he goes to apply for a house with 5% down. The home price is $400,000 with a total mortgage balance of $380,000. Over the course of a 30-year mortgage, John's payment is $2,039.92. Over the course of that 30-year loan, assuming he didn't pay any extra amount, he will have paid $354,371.98 in interest. causing a total loan amount of $734,371.98. That's a ton of interest. But you might be asking, okay, what if I had bad credit? John had good credit. So now we're gonna switch over to Matt. Matt has the exact same house at $400,000 with a 5% down, has a total loan amount of $380,000. Matt has a little bit of a subpar interest, or a little bit of a subpar credit, and that causes Matt to get a 8% interest rate. You might think, oh, it's only a 3% interest rate difference. It might not be too much. But look what happens to the monthly payment. Instead of a monthly payment of $2,039.92, Matt's payment is $2,788.31 every single month for 30 years, causing the total interest amount to be paid as $623,789.94. Matt, as a total for that house, paid $1,003,789.94 for a $400,000 house because he had a worse credit score. Now, if we put that into the calculator, that means that Matt's spending over $270,000 more than John over the next 30 years on just his home. That is a drastic difference. So to fix your credit, the first thing you're gonna wanna do is get it together. So stop using the credit and keeping a balance on it. That's number one. Number two is get the credit utilization under 30%. The soonest you do that, then you can start rebuilding your credit. Number three is completely paying off your cards and continuously paying off the balance every single month. When you do that, it's gonna help you build your credit. And after you do that for 5, 10, 15 years, keeping consistent with the bank, they'll see that longevity and they will reward you with a good credit score. And when you go to get a home or a rental property, you can use that to your advantage. That is almost $300,000 saved on just one house. Imagine if you had a rental property or 2 rental properties and you were paying over $1 million in interest more than the other guy that had a good credit. A huge reason to increase your credit is right there, just by buying a house.